Hi, this is Jim Cunningham. We're going to talk about donor advised funds versus private foundations, a bit of a smackdown, which is better. We're going to talk about what they are not. So, on a very high level, a donor advised fund, you can think of it as an account. A private foundation is essentially a corporation, like a business type entity. It's an entity that you create. So, really fundamentally different roles. I would say the donor advised fund, again, very high level, significantly less care and feeding. That's kind of automated. There's a process for it. Private foundation, you're kind of doing that on your own. So a bit of a heavier lift, and in some ways to get to a similar destination. So I've got Christina Lindsay Orta here from Ascent Wealth Management. She'll be joining me, and we will talk about all things donor advised funds and private foundations. So let's talk about a donor advised fund, Christina. Why are they less hassle than a private foundation? And what do you see people using, and maybe some amounts? And I know we're going to get into this, but maybe just as a sort of a preview of what we're going to talk about, what are some of the things we'll be talking about?
Yeah, we're definitely going to be talking about donor advised funds as to how they work, how the different features of them. They don't have as many distribution requirements. They're very easy to set up. They're very there's a lot of ease of use in working with the donor advised funds, and private foundations have a lot more complexity. Like you mentioned, it's an entity. You're setting up a business. There's a lot of tax filing regulations. There's a lot of regulatory oversight. So it's a bit more of a heavy lift. So we're going to kind of dig into the weeds about the differences.
Great. Well, I'm Jim Cunningham. I've been an attorney now for 30 years. Can't believe it. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, a insurance and securities licensed, and a pilot single engine land, although I'm not current, and instrument rated. These are the attorneys in our firm. We are dedicated to all things wealth creation, preservation, and passing it to the next generation peacefully, ideally, not with any sort of conflict or litigation. And Christina is one of three certified financial planners at Ascent Wealth Management joining me here today. So welcome, Christina. I'm a lawyer. I'm talking. This is not legal advice. So this is information. We have a lot of videos on our YouTube page, and we do put a lot of time, effort, and attention into this. But please, this is not legal advice, not a substitute for legal advice. It's designed to teach you and for people to learn and sometimes have a little bit of fun. And do you want to talk about your disclosure, Christina?
Yes, we want to be clear that we are licensed financial advisors. We do have an RIA registered with the SEC, and we're also registered representatives through FINRA, registered through Cambridge. So we do have different licenses. We want to make sure that we're clear that we're not making any kind of an investment recommendation or securities recommendation, nor giving investment advice. So we do that on a personalized and individualized basis. So this is meant for education and not to give specific advice.
Great. Well, one thing we're going to be covering here is the private foundation. And again, it's its own organization. It's its own structure. A donor advised fund, just mentally, you can think of it as an account you open, like with somebody like Christina. You open a donor advised fund. There's a lot more thought that goes into it. How the organization is structured, you have to have governance. These are typically corporations that's what people use, are corporations. And there is more flexibility, so you can do non-cash contributions, and maybe we can compare and contrast a little bit. But give me your insight, Christina, onto what private foundations are, and really from like a financial advisor standpoint and how they work.
Yeah, so I think starting with just what are they? So a private foundation is a charitable organization. I think when we think of private foundations, we think of the Rockefellers, the Vanderbilts, we think of like the old money and the big, the Gates Foundation. And those make a lot of sense when you're dealing with the uber wealth. Typically we're going to kind of get into the weeds as to the why. Private foundations, I would say by and large, don't make sense unless they're 5 to 10 million or more. There's a lot of requirements that go with them. So you said flexibility. I'd say yes, flexibility on assets that can go in a private foundation, less flexibility when it comes to managing and all the requirements that go with it. So a private foundation in its simplest form is a charity that you are setting up for some sort of charitable intent and purpose, where once those funds kind of go into that private foundation, those are for the purpose of a charitable strategy, a gifting strategy. So
Not
those would
not to employ your kids. So a lot of people they say, Jim, I
correct.
want to create a private foundation so that I can have a job for my kids and pay them a salary. Yeah,
That's not the purpose.
that's
Yes.
not really what we're talking about here. We're talking about really dedicating these funds for charitable purposes.
Correct. Yeah.
How does
So
a donor advised fund work? And let me give a little context for this. We're recording this in late December. A lot of people they say, gee, I want to make a charitable contribution. I just don't know who to make the charitable contribution to. Right. So I'm going to set aside $100,000. And so I can deduct that from my income. If it's deductible, right? If you haven't made other charitable contributions and you have enough income. So that is going to be deductible. That's going to save you on your taxes. But you say, I'm just not sure I want to give the money to the charity right now, or I don't know which charities to give the money to, but I do want to take $100,000 and dedicate that for charitable purposes. I think a donor advised fund is a perfect fit for that. It's kind of a freebie in a sense where just because it's charitable, it's very important with a private foundation. Just because it's charitable doesn't mean that lawyers and CPAs don't charge for their services. And we were working on one charity that received more than $2 million in contribution. When you receive more than $2 million of a contribution, you have to produce audited financials to the California Attorney General, which was like $25,000 in accountancy fees. So
more
there's a
like
lot that
50,
goes with that, right? A
more like
donor advised
50.
fund doesn't have that.
Mhm.
So maybe help unpack that a little bit.
Yeah, no, as a treasurer of an organization that just went through this, it would cost us 50 to 60 grand a year just to produce the audited
Yeah.
financials. So so a donor advised fund, I kind of want to we're kind of getting into the weeds a bit, which we're certainly going to digest how these work and some case studies as to like what's an appropriate use case for donor advised fund. There are many donor advised funds out there. And so a donor advised fund is typically run by a larger organization, but then you have an individualized account. So for example, Fidelity has them, Charles Schwab has them, Vanguard has them. There are other local donor advised funds in the local communities that have them. So there are big ones, there are small ones. When we're dealing, especially with the larger firms, and we're going to talk about some examples of how we use Charles Schwab's charitable platform. While that's the parent organization basically doing all the filings, all the regulatory audits and compliance documentation, they're doing it at the corporate level, like Schwab's doing it, Fidelity's doing it. The individual is not having to go through all that. So the individual is setting up their own giving account. And you can call that account whatever you'd like. You can call it the Cunningham Legacy Fund, the Cunningham Giving Fund. You can make that your family legacy. That can go multiple generations. So the idea is you create this account, you can contribute cash or publicly traded stock or restricted stock. Other non-cash assets are difficult to do with a donor advised fund. So that is one key distinction between a
Right.
private foundation and a donor advised fund. If you're dealing with gifting real estate or other corporate interests, different. We're going to talk about that in a little bit later in the presentation. But donor advised funds work great for giving cash or stock. Contributing appreciated assets that have been held for more than a year will allow you to gift without having to recognize the capital gain and then take a deduction, especially if you do not itemize on your tax return. You may not benefit from recognizing the gain and then doing the gift. It's
Right.
better to just do the gift as an above the line deduction on your tax return to get the most impact. The other thing on the investment side, so I want to talk about once you've contributed, how those funds can be invested. Jim mentioned, okay, what if we want to just give to a charity? We need the tax break. We know we want the money to go to charity. We just don't know who. We don't have time. We don't know what charities we want it to go
Yeah.
to. We don't want all of it to go right now. We can contribute to that account, recognize the tax deduction in that tax year, and then in a donor advised fund, that money can be invested, or it can, like if you even gift shares of Apple or Disney or other shares of different stock, it can sit there and then we can sell it or we can leave it. We can let it grow. We can invest in all different kinds of investments, mutual funds, stock, all different publicly traded investment options. Let it grow and we can gift at a later date. There's no time requirement. It just means that once the funds go in that donor advised fund, they have to come out to a 501c3. So the grant, when the money comes out of the donor advised fund in any amount, whether it be $1,000 here, $5,000 there, it can go to any 501c3 that is a publicly registered charity.
So, Christina, let me ask you a question. Let's say I've got highly appreciated stock. I've got some Apple stock that I bought for almost nothing. It's worth 100,000. Can I take that $100,000 in Apple stock, move that into a donor advised fund, and then go out into the open market and purchase $100,000 of Apple, and effectively increase my basis in the Apple stock? So, on a subsequent sale, I'm saving capital gains tax, right? As long as I've had it more than a year.
Correct. So, this is the time of year where I'd say that we are most busy between November 15th and December 15th, largely doing tax planning for a lot of our business owners and high net worth clients. And one of the major things that we're focused on right now is funding donor advised funds. So, perfect example, clients that get RSUs or have a lot of RSUs over the years or get stock as a part of their compensation.
Right.
What we just did with a major executive is we took all of the low basis stock that they've had for decades. And because they just got all this new vested RSU stock that they got as part of their compensation is going to be extraordinarily high. We took some of the low basis, gifted it to the charity. And so they're getting that tax deduction, but they don't have to worry about giving it this year. They can let it sit there. They can take their time. And we got the thing that has the biggest capital gain tax consequence if they sold it for their own personal use. We put that into charity.
Yeah, and that's really important because when it comes to RSUs, you're paying a lot of in California, you're probably paying
Ordinary
50% income tax. So it's nice when you make that gift of other assets. If done strategically and properly, it can really mitigate the amount of income tax you pay in this year just by moving assets from one bucket to another. Yes, you are dedicating those assets to charity, but I would say for our high net worth clients, Christina, if our clients aren't giving to charity, oftentimes they're just not our clients, because if you've been blessed with a lot of, a lot of wealth, most people are giving to charitable organizations in one form or another, or dedicating some of those resources to, sort of the greater good.
Yep. And the one thing I want to be clear on too is that once the money has gone into the donor advised fund, similarly with the private foundation, when the money comes out, and you do ultimately send that gift. So let's just say you put $100,000 in a donor advised fund and it grows to be 200,000, and then you make $200,000 worth of gifts. You don't get another tax deduction on the delta. So I want to be clear that once you give that gift to charity, there's no tax deduction at that time. You're recognizing the tax deduction at the point of contribution. Anything that is in that donor advised fund has to go to charity. You can't come back out for any personal use. So what I want to highlight, I'm highlighting the DAF Giving 360 a bit, just because that is the Schwab platform that we use. We use Schwab Institutional. We're independent advisors. We're not retail advisors with Schwab, but we can use any platforms. I've used Fidelity. I've used Templeton. I've used Schwab. Schwab has got ease of use. Just in their platform alone since 1999, and they started this giving platform, over 35 billion has been given to charities.
Wow.
So a lot of people have adopted this form of giving. And again, it benefits donors and charities. It's a way to minimize taxes. The other thing that charities are always needing is money. And, for many times charities, it's better for them to sometimes get a consistent gift. If they go, hey, I know I'm going to count on this $1,000 a month versus this one-time lump sum. Those are helpful, certainly, if there's certain giving funds and projects they're working on. But if you could have this donor advised fund that's fully funded and basically commit to a charity, like, hey, we're going to send $1,000 a month for the next 2 years. We're willing to give that commitment because we've got enough money in the fund to do that. That is very beneficial for charities, and it allows the money to grow without any taxes. And so these are all the different types of assets that make really good charitable gifts. You can gift crypto, you can gift life insurance, you can gift business interests. There's some nuances there. But you can gift all of these different things. It is being sure that that type of donor advised fund that you're using can accept these types of gifts. So that's really where sometimes we have to get a little creative and maybe go off the national platform types of donor advised funds and work with a donor advised fund that is maybe more boutique, that can accept non-traditional investments, but they do exist. So these are things that can be gifted to a donor advised fund or a private foundation for that matter. So this is an example of why it's good to gift that highly appreciated stock. So if we have this stock XYZ purchased for $5,000. Now this is a kind of, in my opinion, a watered down tax analysis for someone that lives in California that might be living in more of a 15.
Right.
Our high net worth investors are paying a 20% capital gains tax. They're paying an additional 3.8% net investment income tax. They're then paying an additional 13.3% state tax. So even in the capital gain realm, when you're dealing at a more effective tax rate, you're looking at maybe 35% taxes in California. So this is probably a more exponential number when you compound it for California or different states. So, but in this example, using the $5,000 cost of that stock that has now grown to $50,000. If option one client decides to sell that stock, they're going to pay $6,750 in taxes and then only have $4,300 to contribute to charity.
43,000, yeah.
I'm sorry, 43,000, not 4,300, 43,000. And to the extent that that client doesn't itemize on their taxes, that doesn't even benefit them on their tax return. Option two, we don't recognize any capital gain tax. We gift the entire 50,000, get the benefit of that deduction, and then save $12,000 in taxes.
Yeah, I mean, on a high level, the money is not going from the sale of the stock to the government, the state and federal government. It's going entirely to the charity. So it works, right? I mean,
charity gets more,
yeah.
You save more. So that's really the why. This is really just talking about the tax-free growth potential. Now, if you have, you can do direct with Schwab, Fidelity. Again, many of the different big platforms, you can do $10,000. You can set it up yourself. You can start small. When you're going into those like $0 plus investment pools, they might have some pick and choose. Like if you gift Apple stock and then you want it to be diversified and not be as risky, you can have it pick and choose. You kind of have to pick and choose from different investment options. Once it's $100,000 or more, we can continue to just hold that single stock position, or we as advisor can then diversify it further for what your needs are. If you say, hey, I want to make sure that we've got $1,000 a month to go to these charities for the next 5 years, we're going to put that part more, conservatively invested to make sure that that money is there, that the charity can rely on that. But we can invest in different types of portfolios and individual stocks once it's 100,000 or more.
And there's no requirement that, at least currently, that money that you put into a donor advised fund is distributed during any given calendar year. That is not the same with the private foundation. You have a
Correct.
5% distribution requirement with the donor advised fund. You just simply don't have it, right?
Yeah.
So, but the interesting thing is, I think what the latest figure was like 20% of all assets in donor advised funds go to charity every year anyway. So the government's like, why impose like a 5% minimum when already 20% is going to charity? It's like, hey, if it ain't broke, don't fix it. Don't tell people in the government that. They might actually pass another regulation. Okay.
This is the ease of use. So I've got some of my family has the Schwab Giving Donor Advised Fund. It's so easy to make a grant. So if you're at that auction and you're, wanting to bid on something, or you're wanting to be charitably inclined at this, fundraiser, right, you can go on your mobile phone and you can type in the tax ID or type in the name of the organization, have a check, click send. You can put a memo in there that this is from, the Cunningham family. And the only thing that we have to do is tell our clients before you do that, just make sure that we've got a cash in the account. Because if it's currently invested in Apple stock, then we're not going to be able to have that check go out. So we just need to make sure that there's cash in the account, and then you can make those gifts however you want, whenever you want.
It's very important to highlight here what is written on this slide is it is easy to recommend a grant. So a donor advised fund is not a donor directed fund, right? So it's an advised fund, meaning essentially it has to be a 501c3. So we have a question in here that said, well, what about nonprofits? How are nonprofits different from private foundations and donor advised funds? You can think of a donor advised fund and a private foundation as a source of funds for other nonprofits, right? For other boots on the ground people who are, helping out nature or other humans or animals or whatever it is. These are charitable endeavors that are carried out. Sort of the laboring oar, if you will, is on the nonprofit side. So these are funding mechanisms. It's almost like a bank for the nonprofit, where they're going to be supplying the nonprofit money. So these are not sort of operating foundations we're talking about. These are what we would call a support organization on the private foundation, or the donor advised fund, which is giving money. The other thing I do want to mention is, if you are watching this and you say, gee, I attend some charitable event every year, and the tickets are very expensive, and I like to bid on things. You're going to need to ask the charity how much of that, if it's a $2,000 ticket to an event, how much of that $2,000 ticket is the food, right? And how much is a contribution? And they'll tell you that. But what you can't do is, you can't use the donor advised fund for the full $2,000 ticket. You would have
Correct.
to subtract out the thing that you got in exchange, the rubber chicken and the glass of wine or whatever it is. And that's something they should be able to tell you. But this is a way where you could preload money and use this to spend in a way that you already spend right now, right? I mean, if you're watching this, you have an interest in this, obviously, and you might be attending these events or supporting these organizations. And this is can be a more efficient way to do that.
Correct. And this is how the charities will receive the check. And so you can designate it. So to your point, Jim, it's donor advised, but you're able to advise this is a designation for this purpose, the building fund or what have you. And you can have it be anonymous, or you can put your name, and the check will go directly to the charity.
Yeah, and if you say, gee, I'd like it to be a balloon party and only invite Republicans, the answer is going to be no, because I don't know that a balloon party, and if it's only for Republicans or only for Democrats, or pick your party, insert party, that once you get into political side, that is not, okay, that is not charitable. Okay, so that is covered. Those are different classes of organizations. So let's say, Christina, someone wanted to have a donor advised fund to support a particular political action committee. That would be an example of something you could not do with the donor advised fund. You would have to do something else, right?
It has to go to a 501c3, not a 501c4. A lot of the 501c4s are political organizations, PACs. Those things are non-taxable gifts, but not tax deductible, not non-profit.
Yeah, and there are a lot of organizations. I know Planned Parenthood's one of them that has both the 501c3 side and 501c4, and there are other organizations as well. So there's a whole range of them.
Mm-hmm.
Okay.
You can designate family members. So much like a private foundation, and this is, we're going to get into the private foundation as well. And there are use cases for that. We are focusing more on the donor advised funds because they are by and large more widely accessible and have such an ease of use, and they can be treated just like your own family private foundation legacy giving fund. You can designate family members or charitable beneficiaries to carry on the legacy of that account. So you can literally set up the Lindsay Orta or Cunningham family legacy giving fund and designate in your trust, I want my kids to be the successor managers of this account. And they're then going to be the advisors of where those gifts go to. And you can basically force your family to sit around the Thanksgiving table every year and figure out where they're going to give money to.
Christina, we were talking about appreciated stock, but what if you have a stock that has gone down in value? It's probably better to sell that stock
and then gift.
And then gift the proceeds, rather than gift a stock, then
Correct.
gift the loser. So this is part of like tax loss harvesting, right? That you're also doing that with clients. Although, I don't know, there haven't been a lot of losses, at least.
Not this year.
Not this year, which is good, right?
Which is good.
Yeah.
So yeah, you had mentioned this earlier. What are the different types of causes? We've got religious institutions, your church, your kids' private school, educational institutions, your alma mater, your university, human services, the environment, wildlife. So these are all different things that can be given to through a donor advised fund.
It's interesting. I think about the giving I've done, and it tends to be the educational institutions and human services. Um, Interesting. I guess we all have our own,
Mhm.
um, probably culture would be in there as well. I guess that's educate. Where would you put art museums and probably educational ish?
Educational,
Yeah.
libraries. Um, Donating appreciated non-cash assets can also help reduce taxes. So we've talked a lot about taxes, and that's, there's two purposes here. It's for the heart of giving and for the greater good. And those that are blessed by much are expected much, and helping others, but then also taxes. It's how do we give smart and mitigate taxes in a very well supported way. That's supported. The thing that's most supported in our tax code is charitable giving. And
So let me ask you, what about somebody who has an apartment building or a piece of real estate that is depreciated? Does that work for a donor advised fund, or is it more of a charitable trust or private foundation? How does the real estate work?
we could look at a charitable trust.
Okay.
We could look at I would say that a charitable trust might be the most advantageous go-to, which we've done some webinars on charitable remainder trusts, charitable lead trusts. Those are things that we could look at doing.
The other thing too is if you have debt on the property, it complicates
Complicates
the
it.
gifting, which you wouldn't have debt on a security necessarily. But real estate, oftentimes you do have debt. And certainly if your debt is over your cost basis, that's a real problem when you mix that with the charity. So that's kind of a no-go zone. And we've covered that in other
Yeah.
webinars. But if you're
And
watching this webinar and you're thinking, yeah, I've got this real estate I want to sell. I want to maybe move this real estate into a trust, or I want to give the real estate now, pick up the deduction, but not sell it for a while. That's something that would be in the charitable trust purview and may or may not work, quite frankly. So that might be a charitable remainder trust where the terms of the trust or the timing of the payout changes based on an event. But that's
yep.
something, if you're thinking real estate, I would be looking more toward the charitable trust vehicle. And if you're thinking publicly traded securities, either work, but the donor advised fund is kind of I would say that's the least, Christina. Like, what's involved in setting up a donor advised fund? Don't they just call Ascent Wealth Management and say,
Yeah.
open up an
Yeah.
account, and you go, okay. And it's like that's what happens.
Right. And if you want to just go back one slide, I just want to hit on the point for just a moment, Jim, that that second point there is that you can claim a charitable deduction for up to 30% of your AGI. So you can't gift away all of your income. To the extent that you do gift away more than you can write off in that year, you carry forward that deduction. And it
Yeah,
can be
so this
carried
is
forward
for
5 years.
so it's 30% of appreciation you can think of. So if you paid a dollar for something and it's worth 10, that $9 gain, that has a 30% limitation. It's 60% for cash. So it just depends
Correct.
on what you give.
Yes.
But you really, and again, this is why we talk about the A team and the three-legged stool. Before just like going on your own to Schwab or Fidelity and setting up a donor advised fund and moving a bunch of stock in there, you need to pay attention to basis. You need to pay attention to your adjusted gross income. That is not necessarily your income, but this is
Right.
adjusted gross income. So these are math calculations that are primarily the purview of your CPA and your financial advisor. The other thing
Correct.
this does is this necessarily affects your estate plan. So if you're giving away an asset that somebody wanted in the family, or maybe one of your kids says, uh, parents, I would rather have you. I mean, I never had this happen before, but somebody might say, instead of leaving me $1 million, just go ahead and put that into a donor advised fund, and your estate plan leaves everything equally. You're going to need to make an adjustment to your estate plan. So sometimes these gifts do have an outsized effect on, frankly, on maintaining family harmony when you're gone. And I will tell you, that is probably one of the biggest issues we face after people pass away, is maintaining family harmony, because all this stuff that people may have buried their whole adult lives, it comes out, it rears its ugly head. And Christina, I see you shaking your head. I'm not going to say anything, but we've seen it a lot, right?
Yes. Jim and I have met when I was 18 over that. And so, yes,
You're right. I've let you mention that.
yes, Jim's had to represent me many, many years ago. Uh,
Um,
so Yes, but this would be a way to keep some family harmonies as
Yeah.
well. If part of your legacy isn't just wealth, it's giving, and the importance of giving, and if that's important to you, how to instill that legacy in the next gen, is another great reason to use these types of structures. And so, um, private foundations, we're going to kind of get into a bit more and how they're different. And
Yeah.
so,
Yeah. So what this is a corporation, meaning you set this up in California. You'd go through the Secretary of State. You set up a corporation. You have your articles of incorporation. Could you use another jurisdiction? Yes. But for if you're in California, we're going to typically use the California laws to set up the private foundation. It is subject to oversight by the California Attorney General, which is kind of important to note. If you have to make a distribution of 5% per year to at a minimum of 5% per year. So if you put real estate in a private foundation, that might be hard because how are you going to distribute 5%? I mean, that's not really going to work. You'd have to sell the property. And that's why I said a little bit earlier, if you're going to put real estate into a charitable vehicle, the charitable trust might be a superior vehicle because you can write a charitable trust to not have any current distribution.
and
So a little bit
Jim, that
different.
should be we'll have Ashley make a reminder. We should actually do a webinar just on flip cruds because we've got several case studies that we're doing on those right now. So we'll do a webinar on that next
Good.
year.
That the flip cuts work really well for appreciated stock, for
Yeah.
crypto, for a lot of different
Yeah.
lot of great
Private stock that isn't public yet, those kinds of things.
right.
So talking about private foundations though, private foundations, those, like you said, can be domestic or foreign organizations. They can be something that is geared towards specific types of charitable giving. So it could be that you're doing your own giving, or it could be that you're supporting other 501(c)(3)s, but you want it to be, your family foundation. But they're typically going to have some sort of a narrow scope in what the types of giving are. Like it can't be these types of organizations. Your focus is, 4-H and, agriculture and, young farmers and whatever it might be. Additional IRS rules.
Yeah.
Private foundations have a lot of additional regulations. All these IRC codes are because there's been historically a lot of abuse of
Yep.
private foundations. And net investment income tax, that 3.8% Affordable Care Act tax that came as a result of the Affordable Care Act, is IRC 4940, where private foundations do have to pay some of that excise tax. There's self-dealing rules. Again, you can't just sit there and employ your kids or gift to. I actually had a young lady, young woman who's in college come in here the other day, and she red flagged at a charity and reported them because they were keeping all the endowments and gifting for college gifts and scholarships only for their own family members.
Yeah.
And so these types of things, you just run into a lot of self-dealing rules that are very, very difficult to overcome.
Yeah,
So
if that's the plan you want, go to a different law firm. Don't go to our
yeah,
law firm.
yeah. So there's definitely a lot more additional scrutiny, oversight, taxes, regulatory filing requirements.
Yeah.
Whereas the donor advised funds, those requirements are met by the sponsoring organization. So if it's Schwab, if it's Fidelity, again, those are going to be those that are required. It's not going to be the individual investor that's having to meet all these, different regulatory requirements.
And we're not, listen, the point of this is not to say don't do a private foundation. It's just that if you go, gee, what's better? Most people want simplicity. Most people don't want to have the added just to do a bunch of stuff. Now, if
Mhm.
that's you, if you're like, gee, I like to get up and I like to have to do a bunch of regulatory reporting, then, obviously private foundations probably better. But I would say we talk people out of doing private foundations who come into our firm and say, gee, I'd like to do a private foundation. A lot of times they end up doing a donor advised fund or they end up doing a charitable trust. Okay.
Correct. Correct. Yep. So you have a lot of different fiduciary duties. So side by side, let's kind of like talk about how these all work in a direct side by side. And so private foundations, the startup time you have to apply for that determination letter from the IRS. You have to work with attorneys. It's probably going to cost you $50,000 in legal fees to set one up. And then having a CPA that will do the financials of the private foundation. Donor advised fund, easy. I'd say it takes us a week at most. It's not as quick as a normal account just because you do have the layers of the oversight with the platform, but it is a week or less, and you don't have a different tax ID. You're the manager advisor of, but it's no longer your asset. You're putting it in here and you've got the directed control of that asset and you've got purview to it, but it's very quick to set up an account. Again, startup costs, very extraordinary with a private foundation. And then tack on a 5x that when you're dealing with complex illiquid assets, business interests, debt, those types of things. So when you're dealing with more complex assets, it gets even more expensive. When you're dealing with the donor advised fund, those typically are going to be about 60 basis points. And then whatever the internal expenses are of a mutual fund or ETF that you're investing in. So they're not.
Explain what 60 basis points is. If I'm investing $1 million, how much is 60 basis points?
$1 million, you're going to be at 0.6% a year.
6,000.
Yeah. So, so that's really where you're looking at the different comparisons here. Size requirements. Again, this is kind of a general broad rule of thumb. In California in particular, I would not recommend doing a private foundation unless we're dealing with, 10 million or more, unless you have something that's maybe worth 3 million today and going to be worth 50 million, then maybe we're looking at a different structure. Or maybe
so a lot of times people say, well, I have this business and I want to put 10% of my business into a private foundation. You're not going to avoid a lot of the tax. You're going to be subject to a lot of taxes. It's just not this it's not this place where you can just willy-nilly move assets in there that are never taxed. So again, there's a lot to that, but I think that would be another common one where people say, gee, I want to pay less tax and I want to move some of these of my business into a private foundation and employ my kids, which is a backdoor way of, paying a lot less tax. It just doesn't work that way. So you got to be mindful of that.
And not to say that you can't have a child or heir serve as the CEO of the private foundation and collect a salary.
Sure.
But again, it's got to be reasonable. They're not going to just be able to go sit there and collect $1 million paycheck and do nothing. They're going to have roles, responsibilities, be subject to the scrutiny of the audits, and it's going to be disclosed in their 990, because a private foundation is going to have to file a 990 every single year. You're not going to have privacy, which is why
Tax returns
on the tax return, there's going to be scrutiny of who's getting paid, who are the officers of the organization, and exactly what they get paid is public. And so if we go back a second, I know I jumped ahead to the 990. But there isn't a lot of privacy. So size requirements do matter. And again, donor advised funds, you can get them as little as 5 to 10,000, depending on where you go. The choice of donating property, we talked about that. Lots of limitations when you're dealing with private foundations. There's the excise tax issues, but you can gift more illiquid complex assets to a private foundation. You have less limitations on a donor advised fund, but they're going to be more restricted to typically cash and securities and liquid stuff. The investment funds, private foundation can invest in real estate. They can invest in non-traditional investments. And whereas a donor advised fund, you're going to be pretty much investing in mutual funds. Once the asset is sold, you're going to be investing in mutual funds, stocks, ETFs, more liquid traditional investments. Federal tax treatments, very, again, the completed gifts, I think, and what's important here from a wealth tax standpoint is this also is a great way to get yourself below the estate tax. So if we can gift some of these assets out of the estate and they are appreciating outside of the estate, you're getting the tax deduction now, but they're also not includable in your gross estate upon death. So it's a great way to transfer wealth as well and not have an estate tax due on those assets. And we've talked about the limitations as far as deductions, cash contributions to a private foundation are at 30% of the donor's contribution base, whereas cash contributions to a donor advised fund or directly to a charity are 60%. So you have a few more limitations on how much you can contribute of your income to private
Now,
foundation
if you're
versus
really
staff.
motivated and you say, gee, I like both, I want to do both, you can do both. And you
Yeah.
could have your 30 and 20% limitation. And then on the next layer, move money into a donor advised fund. So you can kind of stack these if you were
Mhm.
really committed on doing both. So you did mention the essentially the estate tax or death tax. Something to be mindful of is if you're a resident of a state that has a state inheritance tax. Now, for
Mhm.
example, Washington is a 20% tax on amounts a little bit over $2 million. When you make that gift, even though you may be below the $14 million federal threshold, you still may be subject to that 20% death tax. And if that really bugs you, you say, I'd rather just give these assets and put my kid in charge of a donor advised fund. That's something you could do as well. But
Right.
bear in mind that there are taxes on the state level as well in some states.
Exactly. Yep. So again, annual maintenance costs, donor advised fund, it's just a percentage of the assets that are in the account. So the fees are fairly minimal. And the annual cost again for private foundation between filing the 990, doing the audited financials, you're probably looking at least $50,000 to $60,000 a year.
Yeah.
So that's really where you do get to be quite a bit more costly.
Sorry about that.
It's okay. Next slide. There we go. And this was the last slide, and then we can kind of go into some Q&A. Was just that the comparison side by side. Again, no taxation on earnings in the donor advised fund. The thing I want to, whereas on private foundations, you do have the excise taxes, you do have up to 2% tax on any of the investment earnings. So if you invest in, again, Apple, I'm using it as an example, you invest $100,000, it becomes $200,000, you're going to pay $4,000, you're going to pay $2,000 in taxes on the gain, the $100,000 gain. And annual distribution requirements, this is the key distinction. So charitable trusts, private foundations, they have to distribute 5% of the assets, including operation expenses, every year. So if you got a $10 million, private foundation or $100 million private foundation, you have to give $5 million a year. You have to. Whereas a donor advised fund, you can let it sit there, you can let it grow, you can say, hey, I only gave $100,000. I want to wait till it's $200,000 and give a more meaningful gift to charities. You can do that in a donor advised fund. You can't do that in a private foundation.
I mean, and this is interesting because if you're already giving 500,000 a year, it might make sense to put in 5 million or 7 million or 8 million over time, not necessarily all at once, because when you see this 20 and 30% limitation, you would have that deduction carry forward. So I guess where I'm going is if someone's making $3 or $4 or $5 million a year and they want to put 2 million a year into a private foundation, that's a very expensive endeavor. And if you're going to be distributing that money anyway, even at the higher numbers, it may just be less headspace to do a donor advised fund, to go ahead and move that 3 or 4 or 5 million into the donor advised fund, knowing you're giving away 500,000 a year, right? If you have like a bigger year. So I think this is where it makes sense to get, again, your A team, your CPA, your financial planner. And I guess on this one, the lawyers in there, maybe to help talk the client out of doing a private foundation. That being said, we do private foundations for clients, but we
Yeah.
spend most of the time we end up talking people out of it, and most people end up doing the donor advised fund.
Yep. And then the last thing I'll close with, and we'll kind of go to Q&As, is on a donor advised fund. Uh, it's a great way to, in particular, if maybe most years you're not itemizing on your tax
Yeah.
return. Maybe most years you're taking that standard deduction, but you've kind of got you do like to do giving. You do like to do, giving. Maybe it's only $10,000 a year, but you do giving. If we front load that rather than giving it each year, and we basically say, I'm going to give 3 years worth of giving into the donor advised fund so that I can get the tax deduction on my return and not itemize, it's going to be more beneficial too. So sometimes we're sandwiching gifts in certain years for tax purposes. And that's where it goes back to the A team of really doing that analysis with your advisor your CPA, and then how does this impact your estate plan? Are we going to be able to mitigate estate tax by doing these types of giving strategies?
Yeah, Christina, I met with some clients yesterday, and we were talking about retirement, and we talked about just getting your head around, and they're in their late 50s, a 15-year time horizon. And one of the things that came up is if you're no longer working and you're in your 60s, we've talked about this in other webinars, looking at a Roth conversion, right? Well, the problem with the Roth conversion is you have a bunch of income tax. If you know you're going to give 10,000 a year to charity for the next 10 years, it might make sense to move that 100,000 into a donor advised fund because you're going to be able to offset some of this tax associated with a Roth conversion. So that's why what we're talking about when Christina's mentioning the A team and I'm mentioning the A team, a lot of these pieces fit together, and really it's only when the lawyer, CPA, and financial advisor are sitting together in the same room or same Zoom meeting, I guess now, that everyone sees all the pieces. It's sort of like the three blind people and the elephant sort of figuring out what an elephant is. So it's very important, I would say, to look at this within the context for many of our clients of retiring and multi-generational wealth creation and transfer. So looking at these individually is good, but also looking at them as part of a more comprehensive puzzle. And I would say very few, Christina, very few financial advisors I know even understand that concept, that you have to look at it over time and globally. And certainly not many lawyers do. The lawyers at our firm do, the CPAs that we work with, and certainly Ascent Wealth Management understands that. So
Sure.
with that, our offices are located throughout California, Northern and Southern California. And here is our contact information. If you're watching this on YouTube, and I'll go back to the contact information later, if you're watching this on YouTube, please subscribe to our YouTube channel, and this will pop up in your feed, and give us a little thumbs up. And how much should a living trust cost in 2025? This is, I think this is the fourth time we've done this. How much should a living trust cost? So this is a changing landscape. We will be doing that January 2nd of the new year. So how much is this going to cost you to get your estate plan updated or created? And we will open it up to questions. And if you're watching this on YouTube, please keep watching, because magically another video is going to roll right after this one. Thanks for joining us, Christina.